Hey everyone, Mike DeBlis here. Welcome back to the webinar on your Lifeline for Form 8938. We're now up to Module 2. As you can see here in the table of contents, Module 2 is a continuation of Module 1. In Module 1, what we did was we broke the rule, or Form 8938 rule, down into its key terms, and we define each one of the terms. In this module, we're merely going to pick up where we left off and cover the key terms or elements of the rule and do a deep dive into each one so that we have a solid understanding of what they mean. Now, as I mentioned in Module 1, this is very dry. So I am going to do the best that I can to keep your attention and entertain at the same time. But as you can imagine, that's easier said than done when you're in the world of foreign asset reporting. So what types of assets constitute specified foreign financial assets? As you can imagine, the list is expansive. And the way when I approach something like this, what I generally do is try and put things into categories. That helps me to remember the individual types of assets that constitute specified foreign financial assets. And that's what I try to do here. The two main categories consist of one, foreign financial accounts maintained at a foreign financial institution, and two, other foreign financial assets which are held for investment purposes. Now, the good thing here is that we don't have to take a final examination on what type of assets constitute specified foreign financial assets. So if there's any doubt in our mind, we can always go back to this webinar series or to a publication on the IRS's website to determine if an asset that we're uncertain about actually constitutes an SFFA. And by the way, I am using some abbreviations here just because it would become monotonous to have to repeat foreign financial institutions, specified foreign financial asset over and over and over again. So you might hear me use the abbreviation SFFA for foreign financial specified foreign financial asset, or FFI for foreign financial institution. Let us tackle the first main category. So what items are considered financial accounts? Let's start basic and then build on basic. First are depository accounts. Now, by depository accounts, the first types of accounts that probably come to mind are commercial accounts and savings accounts. But as you can see by this laundry list, depository accounts include much more than just commercial accounts and savings accounts. We're also talking about time deposit accounts, thrift accounts, and get ready now for what is a very lengthy list of accounts. This is in point number 5 here. Accounts evidenced by a certificate of deposit, thrift certificate, investment certificate, passbook, certificate of indebtedness, or any other instrument used to place money in the custody of an entity that is engaged in the business of banking and that is obligated to extend credit, regardless of whether the instrument generates interest. So, as you can imagine, this is not as cookie cutter as you might think. So, it's very important to, really sit down and read these so that you understand whether the type of whether the item that you have meets the definition of a depository account. Finally, the last type of depository account is any amount held by an insurance company under a guaranteed investment contract to pay or credit interest. Let's move to number 2, our second item, custodial accounts. Let's begin with a definition of custodial accounts. A custodial account is nothing more than an arrangement where a person holds a financial instrument, contract, or investment for the benefit of another person. Examples include shares of corporate stock, promissory notes, bonds, debentures, and credit default swaps. Our third type of financial account is equity or debt interest in a foreign financial institution other than interest regularly traded on securities markets. Fourth, cash value insurance contracts and certain types of annuity contracts issued or maintained by an insurance company, a holding company for an insurance company, or certain foreign financial institutions. Fifth, tax-favored foreign retirement accounts, foreign pension accounts, and foreign non-retirement savings accounts that meet special conditions. Sixth, tax-favored foreign retirement accounts. And as you can see here, it doesn't stop there. It also includes foreign pension accounts and foreign non-retirement savings accounts that have already been excluded from the definition of financial account pursuant to an intergovernmental agreement between the U.S. and a foreign country to implement FATCA. They are still considered financial accounts for Form 8938 purposes. So that is a mouthful. Let's just go back once more and make sure that we understand what this is saying. Financial accounts in category in number 6 here include tax-favored foreign retirement accounts, foreign pension accounts, and this is where we get into this very broad class of foreign non-retirement savings accounts. The caveat here with foreign non-retirement savings accounts, as well as the other retirement accounts that are mentioned above, is that even if they have already been excluded from the definition of financial account pursuant to an intergovernmental agreement between the U.S. and a foreign country to implement FATCA, they're still considered financial accounts for Form 8938 purposes. So what is the takeaway? Very simply, while there are certain foreign governments and financial institutions that are not required to provide data to the IRS pursuant to FATCA when it comes to certain retirement accounts, specified individuals who hold an interest in these accounts cannot benefit from the accommodation. I suppose it's a good idea just to back up here and make sure we understand what is meant by the term intergovernmental agreement. An intergovernmental agreement is a key part of FATCA. It essentially gives the foreign bank the permission it needs to turn over information pertaining to U.S. account holders to the U.S. government. There's different models. There's a Model 1, there's a Model 2. These intergovernmental agreements are the product of treaties between the U.S. and the foreign government. And the reason why they are in existence is because A foreign financial institution um, generally um, generally can't just arbitrarily turn over a foreign account holder's information to a foreign jurisdiction. Doing so would actually violate bank secrecy laws in the country where the foreign bank is located. So, in order to circumvent these rules that have a storied tradition in these countries, such as Switzerland, the foreign jurisdictions have had to carve out exceptions so that the foreign banks aren't at risk for criminal prosecution under the existing bank secrecy laws. So these intergovernmental agreements are a product of those of treaties between the foreign government and the U.S. to exchange this type of information to the U.S. government. Let's move on now to items not considered financial accounts. And yes, there are some that are not considered financial accounts. But as you can see by the laundry list of items that were considered financial accounts, it is very broad. But here goes the laundry list of items that are not considered financial accounts. First, certain term life insurance contracts. Second, accounts held by an estate of an individual if the documentation for such accounts includes a copy of the decedent's will or death certificate. Third, certain escrow accounts. Fourth, non-investment related, non-transferable, immediate life annuity contracts that monetize certain types of retirement or pension accounts. Fifth, accounts or products that are excluded from the definition of financial account under an intergovernmental agreement, other than certain tax-favored foreign retirement accounts, foreign pension accounts, and foreign non-retirement savings accounts. 6. Accounts held with U.S. payers. 7. Accounts whose holdings are subject to the mark-to-market rules under Code Section 475. And just so that we are complete here in defining all of the key terms, we're not going to leave anything to chance. We're going to provide the definition for a foreign financial institution. It is a non-U.S. entity that meets one or more of the following conditions. First, accepts deposits in the ordinary course of a banking or similar business. Second, holds financial assets on behalf of others as a substantial portion of its business. Or third, is engaged primarily in the business of investing, reinvesting, trading securities, partnership interests, commodities, or any interest in such securities, partnership interests, or commodities. Now we move to our second category. If you remember that slide with the bucket in it, this is category number 2, specified foreign financial assets other than foreign financial accounts. So what items are considered other SFFAs? First, stocks or securities issued by a non-U.S. person. What would be an example of that? Well, stock issued by a foreign corporation. Second, financial instruments or contracts held for investment purposes whose issuer or counterparty is a non-U.S. person. What are we talking about when we refer to financial instruments or contracts held for investment purposes whose issuer is a non-U.S. person? Well, we're referring to notes, bonds, debentures, or other forms of debt issued by a foreign person. Third, any interest in a foreign entity. And here you can see two examples. First example, a capital interest or profits interest in a foreign partnership. Second example would be an interest swap, a currency swap, or a basis swap. What items are not considered other specified foreign financial assets? So let's back up. Once again, category number 2 states that specified foreign financial assets other than foreign financial accounts are fair game and must be reported on a Form 8938. So just like in category number 1, we defined what foreign accounts were in the first category or covered by the first category, and we also covered in category number 1 what items were not considered foreign accounts. We're doing the same here in category number 2. We've identified the items that are considered other SFFAs, and now we're defining what items are not considered other SFFAs. That's a tongue twister. So first item that is not considered an other specified foreign financial asset: interest in foreign social security, social insurance, or other similar programs of a foreign government. Interesting. Very interesting. That might go against what you might otherwise have expected to meet the definition of other than foreign financial accounts. But these are not considered other than specified foreign financial assets. Second, interest in a foreign trust or a foreign estate, unless the specified individual either knows or has reason to know of the existence of the interest based on readily accessible information. Now, to discuss a trap that comes up on a regular basis for those that are a little unfamiliar with 8938, and that deals with foreign real estate. The issue here is whether foreign real estate owned directly by a specified individual, is it a specified foreign financial asset so that it must be reported on Form 8938? The answer is no. A personal residence or a rental property need not be reported on Form 8938. Now, the operative word here is directly. Is foreign real estate owned directly by a specified individual a specified foreign financial asset? And once again, the answer is no. Now, now that you know the general rule, we're going to discuss a little twist on this whole concept of foreign real estate. But I want you to hold firm to the general rule that foreign real estate held directly by a taxpayer is not a specified foreign financial asset. It will never be a specified foreign financial asset. But now we're going to add a little twist into this. And I don't do this in order to confuse you. I do this because it comes up more times than not. And as I mentioned before, it is a veritable trap for the unwary. Let's assume that the real estate is held not directly by the taxpayer, but is held indirectly through a foreign entity such as a corporation. So what we're talking about here is a situation where we have a taxpayer, let's say his name is John, John owns an interest in a foreign corporation. The foreign corporation, in turn, owns real estate. So that is our basic fact pattern. We have John, who owns a foreign corporation, let's call it ABC. ABC, in turn, owns foreign real estate. Now, the question becomes this: is John's interest in the entity, purely the entity, is that deemed a specified foreign financial asset? We already know that John doesn't have a direct interest in the foreign real estate. However, he indirectly owns the real estate through the entity. So what we're driving at right now is whether John's interest in ABC is deemed a specified foreign financial asset. The answer to that question is potentially yes. Okay, it is unfortunately not prone to a black and white answer, and you'll see why in a second. If the total value of John's specified foreign financial assets held by that entity, by ABC, exceeds the reporting threshold that applies to him, then he must report this specified foreign financial asset on Form 8938. So you've now heard me talk about the total value of John's specified foreign financial assets. How the heck do we value John's specified foreign financial assets in this fact pattern? Well, here's how it's done. We take into account the value of John's interest in the underlying real estate. All right, so what we're doing here is this. We basically need to do an appraisal of the real estate and determine what its fair market value is. The reason being is because if the fair market value of that real estate exceeds the reporting threshold that applies to John, then John has to report his interest in ABC as a specified foreign financial asset on Form 8938. So while the real estate itself need not be reported on Form 8938, it's relevant for purposes of valuation. If the fair market value of the real estate held by ABC exceeds that reporting threshold that applies to John, then very simply, John has to report his interest in the foreign entity, ABC. And that would be what's reportable. All right, so once again, it's not going to be the real estate that is reported on Form 8938. It's merely going to be John's interest in the entity. What is the takeaway here? If the value of the real estate held by ABC exceeds a reporting threshold that applies to John, then John must report his interest in ABC on Form 8938. Once again, remember that John's interest in ABC is the specified foreign financial asset, not the real estate. In other words, the value of John's interest in the underlying real estate impacts whether there is a Form 8938 reporting requirement. However, the real estate itself is not separately reported on Form 8938. Now for a gray area. How about Bitcoin? How about virtual currency? Is that considered a specified foreign financial assets for purposes of Code Section 6038? Well, the IRS has reserved judgment at this time. And because we just covered some valuation issues pertaining to real estate that's owned by a foreign entity, I thought it would be a good idea to end this module um, uh, with a little bit of with a tidbit on valuing a specified foreign financial asset. Now, this might seem very clear cut, but I warn you that it is deceptively complicated. Once again, thanks to the different rules that apply to different types of specified foreign financial assets. What is the general valuation principle? Well, the value of a specified foreign financial asset is normally its fair market value, which can be determined from a reasonable estimate. However, the disclaimer here is that there are different rules that apply to valuation. So you cannot package up this general valuation principle and put it in bubble wrap and rely upon it in valuing your specified foreign financial asset. This is merely the general rule, and there are tons of exceptions upon exceptions. So my advice to you here, as well as in other areas that we've covered in this module, is to go directly to the source, meaning go directly to the instructions on Form 8938 and read them carefully, because once again, general valuation is deceptively complicated. As always, if you have any questions about anything that I covered in this module, feel free to give me a call or send me an email at the email address mjdeblis@deblislaw.com. I also, mentioned this, that the information covered in this module is very general, and it hasn't been customized to any one or any single taxpayer's individual circumstances. What I mean to say is that you should always consult with a tax attorney to get practical and sound advice on your reporting obligations. There's simply no substitute for that. I look forward to seeing you in module number 3.